Okay, so we are in the live class today, and the topic is the audit risk and the responses. So this is a very, very important and technical topic when it comes to your F8 exam, because your audit and assurance exam or F8 exam includes a regular question from this topic. So you may have something within the exam as objective tests, case questions. From this section, you may have the knowledge-based element from it. Like when I say knowledge-based, that means straightforward. For example, what is materiality? What is performance materiality? Define audit risk and components of audit risk. So there are so many topics within this planning section. And then one of the most important thing is the constructed response question from this topic, which is this case study question that will be coming up in the exam. And when you talk about the CR question, the constructed response question, which is the case study, the examiner asks you to explain or describe the audit risk from the case study. And they mention particularly, for example, 5 audit risks, 6 audit risks. And if they're not mentioning it even, you can see from the marks. So for example, they say 6 audit risk, and then the response to the assessed risk, responses. This is a very, very important and technical topic. And if you deal with this topic with the proper strategy, with the proper exam approach, following all the technicalities, then these are the absolute and easy marks in the exam that you can get. So how we can gain these easy marks, audit risk and the responses, and why the students usually fail to get some good marks in this paper, or for example, particularly from this topic. What are those reasons? Now, let me just start by describing the audit risk. So what is audit risk? And what is the background of this topic? So remember the objective of external audit, objective of the statutory audit, objective of external audit, or objective of statutory audit. What is that? To provide reasonable assurance that the financial statements are free from, or whether the financial statements are free from material misstatement, or you can say to provide the reasonable assurance regarding the financial statement, whether or not they are free from material misstatement. So that means when you're doing the audit, you are supposed to give the reasonable assurance to the users, to the stakeholders, to the shareholders, that whether or not the financial statements are free from material misstatement. Now, for example, if you say the financial statements are true and fair, that means there are no material misstatements. Material misstatements mean any misstatements which can affect the decision of the user of the financial statements. When we are saying material, that means we are talking about the significant ones which are able to affect the decision of the user of the financial statements. And we are not talking about the fractional errors, because they may be there. They may be there because we have done the audit on the sampling basis. Maybe there are some fractional errors, small errors over there, but that are not going to affect the decision of the user of the financial statements. But we are giving you the assurance that we have seen that the financial statements are free from material misstatement and financial statements are true and fair. When you're saying this, that means you're giving the shareholders the reasonable assurance. It's not although the guarantee you're giving to them, but they're relying on your opinion, They're relying on your opinion because, for example, if they have to make the further investment within the company shows a good profitability, and you say, okay, this profit figure is true and fair, everything is fine, we have checked, there are no material misstatements in it, there's no overstatement, there's no understatement. So the shareholders actually rely on your opinion, and for example, they buy further shares. But let's assume later they find that your opinion was incorrect. There were material misstatements within the financial statements. The profit was manipulated, and you didn't find those material misstatements, and you gave the wrong opinion. Then they're going to sue you for this negligence. This is the professional negligence, giving the wrong opinion, and the reputation of the audit firm will go down. No one is going to give you the audit next time because you're giving the wrong audit opinions. So that means when you are auditing the financial statements, there is a risk. That means there's a risk when you're auditing the financial statements that you, being an auditor, may give the incorrect audit opinion, and this is known as the audit risk. In simple words, the risk in the audit is that risk while doing the audit is that being an auditor, you may give the incorrect opinion. If you do that, that is going to be the professional negligence at your end, and they're going to sue you for this thing. And no one is going to give you the audit next time because your reputation will dramatically go down, because obviously they will say you are not competent to audit the financial statement because you cannot find the material misstatements. So that means it is something very vital, something crucial, something important for the auditor to make sure that they are giving the correct opinion. Now, what this thing has to do with the exam question, and what this audit risk has to do with the planning stage of the audit. So now we understood the definition of the audit risk, that the risk that the auditor may give the incorrect audit opinion on the financial statement being audited. So the risk that the auditor may give the incorrect audit opinion. Now, this is a risk in the audit. So you have to reduce this risk. Now, from where this risk is originating, for that, we need to understand the components of the audit risk. Although in the exam question, you're not supposed to relate the audit risk with the inherent risk, control risk, and detection risk. I'm assuming that you know something about this topic because obviously this is a complementary class, revision class, or whatever you call it, workshop. So I'm assuming you know something relevant to the audit risk. So what are the components of the audit risk? The components. Okay, let's discuss the components. So the components are the inherent risk, the control risk, the detection risk. When we combine these three risks, collectively, that is known as the audit risk. Inherent risk into control risk into detection risk is known as the audit risk. But let's understand these separately because we have to make the connection of these components with the audit risk, with the exam question, and with the planning stage of the audit. So inherent risk, as it says inherent, that means inherent means nature. Risks likely to occur in the financial statements of the client due to its nature. Now, what does that mean? Inherent, that means something part of the financial statements because of their nature. For example, if your client is a company selling food items which are subject to the short expiry, like for example, let's assume they're selling the bakery items, confectionery items, and they're of very short expiry. The things they're selling is their inventory. Now, the closing inventory is recorded as an asset within the statement of financial position, and also the figure is recorded within the cost of sales. So because it is subject to an expiry, there is a risk that some of the inventory is expired, but that has not been written off, and it is still part of the financial statements. Now, this is not going to be the case for the company which is selling furniture, because furniture never gets expired. The fashion may change, the design may get obsolete, but they are not expired like the food items. So inherent risk means that when I say expiry, this risk is specific to the company because of its nature. Now, for example, if some company sells all the goods on credit, so that means they have a significant receivable balance. Some receivables might not pay, some receivables might struggle to pay. And as a result, the company needs to record the receivable allowances. And if they're sure regarding some balances, they need to write it down. They need to record it as the irrecoverable debt. So there's a risk that some receivables are struggling to pay, but no allowance has been recorded against them. And there are receivables which are not going to pay, and the company is sure regarding them, and they have not written down those balances, and they are still part of the receivable balance. As a result, receivable may be overstated. Now, this is not the risk for the company which is selling the goods on cash. So are you getting it? Inherent risk means risk likely to occur in the client's financial statement due to its nature. Another example. If the company sell the goods and give the warranty on that okay, for example, if you're having problem with the product, you can bring it for the replacement, or we are going to repair it. So whenever they are going to replace it or repair it, there's going to be a cost for the company. And we know if the outflow is probable, the provision should be recorded. So warranty provision should be there when the company is offering the warranty. So there is a risk that they may not have recorded the warranty provision, or their estimate may be incorrect. They may have recorded the incorrect warranty provision, resulting in the understatement of expenses and liabilities. But that is not the risk for the company which is not giving the warranty. So remember this thing, that inherent risk is the risk which is likely to occur in the client's financial statements due to its nature. Another example may be a company which is having the long-term contract, for example, a construction company. Now, their revenue should be recorded based on the stage of completion. They cannot record all the revenue of the contract immediately, neither at the end of the contract, neither on the straight line basis. They need to record it on the stage of the completion basis. There's a risk that the company may record the revenue immediately or on the incorrect basis. Now, this is not the case with the company which is selling grocery, because that is not a long-term contract. Once they perform satisfy their performance obligation, they can immediately record the revenue. So inherent risk is the risks which are likely to occur in the client's financial statements due to its nature. And then we have the control risk. That means the entity's internal control system may not detect and prevent the material misstatements. When we discuss the inherent risk, we assume that there are no related controls, because we were discussing the nature of the entity and the risks coming within the financial statement due to its nature. Now we are discussing the controls. That first of all, it is the management which assures that the risks are not transferring into the financial statement. For example, when you talk about the finance department, so there are, there's a hierarchy over there. We have For example, a senior accountant and the accounts manager and financial controller and then finance director. So why there are different levels? Because when you are getting senior, basically you have the supervisory role. You are reviewing the accounting treatments performed by your junior staff. You're not doing the accounting exactly. You're reviewing the accounting which has been performed by the other accounting, for example, finance director. So they're not, punching the transaction within the system. They're not of that level. They're just reviewing or supervising the whole accounting function. Now, when I say there's no finance director within the company or finance director left the company, so that means there's no one to review the integrity of the financial statement. There's no one to review the transactions which has been performed by the accounting staff, other accounting staff. They might not be competent enough to deal with those financial reporting issues. And as a result, they may perform the incorrect accounting. So this is the control risk. So now you can see that when I gave the example of the receivables, I didn't say that the receivable might get bad and it may bring the loss to the company's cash flows may be affected. I didn't say that at all, because being an auditor, we have nothing to do with their cash flow issues, uh, uh, problems with the profitability. We are supposed to deal with the financial reporting, whether that has been correctly accounted for within the financial statements. When I give you the example of the provision, I didn't say that a lot of complaints will be coming, the customer will be dissatisfied, they might not purchase the product another time from them. I didn't say that at all, because I have nothing to do with that. I have to deal with the financial reporting and the accounting element of that particular issue. That if they're offering the warranty, they may not have recorded the provision over there. And if they have not recorded the provision over there, then the expenses and liabilities may be understated. This is what I have to deal with as an auditor. So similarly, the control risk, I didn't say that if there's no finance director, then the company may have problems within the finance function. The people may blame each other. There may be a blame game, and they may have disputes with each other. I'm not talking about those things, because that is known as the business risk. With every risk, you have to relate it with the accounting. If you're not relating it with the accounting, then that means that becomes automatically the business risk. For example, if you say that receivables are struggling to pay, they may get bad, the company's cash flow may be affected, this will incur loss to the company. This is a business risk. But when you say receivables are struggling to pay, allowance should be recorded against those struggling receivables. If the allowance is not recorded, then the receivables may be overstated. This is the audit risk. So that is why I'm saying in the exam, when they ask you regarding the audit risk, you have no responsibility to relate with it with the business, because that becomes the business risk automatically. You are supposed to relate it with the financial statements. So then we have the detection risk, that the auditor's procedures may not detect the material misstatements. For example, if you are auditing the client first time, this is first time you're auditing the client, your firm has been auditing this client for the first time. You may have the poor or little understanding of the entity, and as a result, you may not detect the material misstatement. This is the detection risk. Now, again, I have related that with the financial statements. And if you're not relating it with the financial statement, then that will become a business risk. In the exam, we are not supposed to identify the risk as inherent risk, control risk, and detection risk. Make sure you're not getting into this thing, because we are not required to do that. Every risk which is in the case study is supposed to be related with the financial statement, just like I have given you the examples. Now, the components of the audit risk: inherent risk, control risk, and detection risk. They are collectively known as the audit risk. So now, if there are risks with if there are risk of material misstatement within the financial statement that due to the nature of the entity and their controls are weak not to detect those material misstatement, and then unfortunately auditor is unable to detect that as well, then those material misstatements will be transferred into the financial statement. Auditor will be saying everything is fine because they didn't detect them, and they will be giving the incorrect audit opinion, which is the audit risk, and this is going to be the negligence at the auditor's end. So understand this point, that every time you have to relate the audit risk with the financial statement. Number one, what this has to do with the planning stage of the audit. At the planning stage, basically you are doing the risk assessment. You do not have the financial statement at the planning stage of the audit. So basically it is being done before the year end as part of the interim audit. So you go to the client, you take the understanding of their systems, understanding of their accounting policies, understanding of their business structure, understanding of their products, understanding their services, understanding the accounting policies. And then you identify the risks relevant to those things. For example, you ask them, okay, so, okay, what is your product? And they say, we sell food products. And then you ask, okay, are they subject to expiry? They say, yes, they have a very short expiry. Then immediately the risk comes to your mind, okay, so there may be some inventory which is expired and they may not have written that inventory down, written off that inventory, and as a result inventory may be overstated. And for example, if they say, the finance, there's an ongoing case on our company, and the customers have sued us. Now we know that, okay, if the outflow is probable, the provision should be recorded. If the provision is not recorded, the receivables the provision is not required, that expenses and liabilities are understated. Now basically you are taking the understanding of the entity and you're doing the risk assessment. You're not having the financial statement with you right now. That will be made available to you at the year end. You may have the ledgers and some books, but not the complete set of financial statement you're having at the planning stage of the audit. So basically you're doing the risk assessment. For the exam purpose, always relate the audit risk with the financial statements. If you are not doing that, then that means that will become the business risk. So I have given you enough examples. So how to write in the exam? So basically you will be starting with the case study line, directly pick up it from the question, then write the accounting of that particular issue, what should have been done, and then what should be done, and then the risk and the impact on the financial statement. I'm not talking about the response right now. I am talking about the risk. So yes, the first thing first, case study line, for example, it says company offers the warranty on their products. Now this is for example the case study line. So you write the accounting treatment. Then if the outflow is probable, provision should be recorded, and if possible, then the contingent liability should be disclosed. This is the treatment. You can simply stick to the provision point if you don't remember the contingent liability thing. Now we will be writing the risk and impact. There is a risk that provision may not be recorded. And this is when the question is silent. They have not told you anything regarding the provision. But for example, if they say they offered the warranty and they have recorded the provision, then don't write there's a risk that they may not have recorded the provision, because they're saying that they have recorded. Then you have to change your answer a bit. There's a risk that incorrect estimate may be made, and as a result, provision may be understated. So there is a risk that provision may not be recorded, or you can say incorrect estimate are made, resulting in the understatement of expenses and liabilities, because the double entry of the provision is debit profit or loss, credit provision. So if they're not recording the provision, then that means they have understated both the expenses and the liabilities. So this is how you are going to write the audit risk within the exam. Start with the case study line, and now you can talk about anyone, which I gave you in the example. For example, receivables are struggling to pay. This is the case study line. Allowance for receivables should be recorded against those struggling receivables. This is the accounting. There is a risk that allowance may not be recorded, resulting in the overstatement of the receivables and profit. Simple. For example, it says the company has disposed of some non-current asset during the year. Accounting of that is those non-current assets should be removed, and the gain and loss should be recorded in the profit and loss. There's a risk that disposed asset may not be removed from the asset register, resulting in the overstatement of the asset. This is as simple as you are hearing me right now. Now, for example, finance director left the company. Finance director reviews supervises the accounting function. The existing finance personnel may not be competent enough to deal with the financial accounting, resulting in the material misstatement within the financial statements. This is the audit risk. So you start with the case study line, you write the accounting treatment. For example, they're making some employees redundant. Redundancy provision should be recorded against those employees. If the provision is not recorded, expenses and liabilities are understated. There's a damaged inventory over there. Damaged inventory should be written off. It should be recorded lower of cost or NRV. If the inventory is not written down to the NRV, inventory is overstated. So this is how you are going to write in the exam. So you can see the length, that the length is appropriate. Start with the case study line, because I've written it very short in the question, usually 2 to 3 lines. You just copy paste it, and then you write the accounting of it, and then the risk and the impact on the financial statements. So this is as simple as you are watching right now. Okay, then moving towards the response to the assessed risk. This is usually the challenging area for the students. And there's a logic behind that, because obviously response is basically an auditor's action and auditor's procedure, and we do it later on in the audit procedure section. But you know, according to the sequence of the audit and according to the sequence of the paper, you have to deal with this thing first before the audit procedure, obviously. So that means sometimes it becomes challenging, but if you grab the relevant approach for it, it will become easy for you. So response to the assessed risk. Now remember that you are at the planning stage of the audit, and you have identified the risk of the material misstatement, that okay, there's a risk that receivables may be overstated, there's a risk that provision may not be recorded, there's a risk that disposed asset may not be removed from the asset register. So these are the risks you have identified so far. Now, what is the response to the assessed risk? Remember, this is simply the auditor's action, or you can say the auditor's procedure in response to the assessed risk. This is the auditor's action or the auditor's procedure in response to the assessed risk. Now, for example, let me just write one. ABC company disposed of some property, plant, and equipment during the year. This is the case study line. Let me write disposed assets should be removed from asset register. This is the accounting. There is a risk that assets may not be removed, resulting in the overstatement of assets. So there is a risk that the disposed assets which should have been removed from the asset register may not be removed. Now this is the risk. And as a result, the financial statement may be overstated, assets may be overstated. This is the risk. Now, how being an auditor, you can check this thing. So it's simply inspect the fixed asset register to confirm the removal of disposed assets. Simple, because it was a risk that they may not be removed. How you can confirm it? Just go to the asset register and check it whether they have been removed. So there was a risk that provision may not be recorded correctly. Incorrect accounting estimate may be made. Then what is the response? Discuss with the finance director the rationale of the basis. The rationale of the basis, that means the criteria based on which they have recorded the provision, and confirm the reasonableness. If there's a risk that inventory may not be written down and it may not be recorded on the NRV, then perform the detailed NRV testing. That means comparing the cost with the NRVs. If there's a risk that a receivable allowance may not be recorded, then discuss with the finance director whether they have booked the receivable allowance against the struggling receivables, and if that is the case, see that within the financial statement that the closing allowance has been deducted from the receivable balance. Or for example, if it is about the irrecoverable debts, then see their receivable ledger control account to see their irrecoverable debts has been removed from there. So auditors action is basically the response, and this is not a rocket science. This is not rocket science, the auditor's action, and this is relevant to the situation. For example, it says the company has spent some money on doing the refurbishment. Now the refurbishment is a mix of capital and revenue expenditure. Capital expenditure should be capitalized. Revenue expenditure should be expensed out. There's a risk that expenses may be misclassified. That means revenue may be capitalized or capital expenditure may be expensed out. Then this is the risk. How you can confirm it? Then obtain and review the breakdown of the expenses from the management and confirm the expenses are recorded correctly within the financial statements. Take the breakdown from them and see, okay, this is the capital one, this is the revenue one. Total them, recalculate them, and then compare with the balances they have recorded. This is the response. So the response is basically the auditor's action toward the assessed risk. Now, if you are not relating the risk with the financial statement, that is going to become the business risk. For the audit risk, you have to relate it with the financial statement. So basically, I have an article which is written on this technical topic, and I've explained all these technicalities over there. And I have also amalgamated all the risks from the exam question, and I've explained each and every one of that with the relevant audit response. So basically, it's a copy paste thing from the examiner answers, and then I have given you how to given you the strategy how to deal with it. So if you read that technical article and you just learn those important terminologies, because every time when you see the planning question, risk assessment question, things are repeating: revaluation, disposals, and then provisions, and then these same things are coming again and again. So if you read my article, the audit risk and the responses, then these are the easy and absolute marks that you can gain in the exam. So hope you understood this easy but technical topic, and I hope you have understood the appropriate strategy to deal with this technical topic, but the easy one. And again, these are the easy marks that you can get in the exam.